Of course, these are very, very bad numbers, widely expected as well for the GDP front. Are we near the bottom now? Could we be near the end of this coronavirus recession? And what would recovery look like?
Well, I think, as my chief economist likes to say, we clearly took the elevator down and we're now going to trudge up the stairs to get back to normal. It really was a long way down. And I think the numbers today, I think, are best understood actually on an annualized basis, kind of on year. So that was 9.5% based on today's figures. That is, as you pointed out, the worst decline we've had since the Second World War. Our view is that it's going to be a long, slow climb up those stairs back to the same level. In fact, we would say that GDP will exit 2021 lower than it exited 2019. And that's really for three reasons. First, we think that we will continue to see these flares of the virus and that will sap consumer confidence. And so consumer consumption will not go back to levels as long as we don't have real confidence that people can go back to a more normal way of living. And we don't see that happening certainly for the next 6 to 9 months. We also think that unemployment will remain really low. You pointed out in the introduction that we've actually seen some worse figures on that front, and you're absolutely right. So we think that there was an initial jump in unemployment, and that now businesses are only going to take people back as they see demand come back, and that's going to be really slow. And last, bankruptcies and foreclosures are now just starting, and those will roll through the next 6 to 9 months as well. And so for all three of those reasons, this is going to be a slow road back, and markets and investors should begin to accept that more fully.
So we have this continued negotiation over the next stimulus package. So far, we haven't seen any progress, but that could be coming anytime soon. We've had the Fed also extending most of their emergency measures already. So how much of what's already been done right now has filtered through the economy, and how effective has it been, especially in reaching those small businesses now that you're talking about more bankruptcies?
No, it's a really good point. I mean, I think we would give the Fed very high marks for both the breadth and the power of the actions that they've taken. And then again, this week, as you said, they've reaffirmed that those programs will be in place for the rest of this year. So I think on that front, we would say that all is being done that needs to be done. On the fiscal side, that's not true. We have more work to do to get money into the hands of small businesses. And I would particularly say we need to find a way to begin to get money to our states, cities, and municipalities. They are going to have an enormous shortfall in taxes as we go through the next 9 months. And we really don't want them to be cutting particularly important emergency services just at the moment. And we don't need them to be adding to the unemployment rolls. So we need another bill, and we need that to focus on small businesses and states and municipalities.
David, we heard from the Dallas Fed President Kaplan earlier this week saying that we need to be mindful of the elevated valuations in risk assets as being driven by, Fed sheet expansion, as well as the perception that there's a very high bar to future rate increases. Is there moral hazard when it comes to risk valuations and the prices that you're seeing in the market at the moment?
Yes, I think there absolutely is, but I think that that's not at the top of my worry list. Our view is that we're now going to enter a period where we will have very low rates, and in many cases negative real rates, low inflation, and low growth. And that is going to really drive a ferocious hunt for yield as people move out of their safe treasuries or other government securities and look for something that pays above zero. Now, we all know that kind of search, and we've actually seen that for the last 3 years, ultimately does sow seeds of its own demise, because it does drive too much capital into some of the riskier areas. But we're a long way from that right now, and I think the most important thing is that we actually get money back into the credit markets and back into companies who actually need time and attention to get through this next year.
So it seems like we've been talking about markets being very dangerously focused on the big tech and growth names, right? But with the results that we just saw in the past few hours, it's pretty hard to bet against the FANGs. Is that where the further hunt for yield is still going to continue?
No, the hunt for yield, I think, will be very broad. I think it's actually most seen in the fixed income markets. Where there's been a real movement back to corporate credit into structured products. I think we see it in real estate debt, without a doubt. And of course, we do see it some in the equity markets. I think we worry less about the narrowness of the S&P growth. Yes, the top 5 certainly have driven a lot of it. But in truth, there are many companies that actually depend on intellectual capital for their growth, whether that's software or intellectual property or patents or indeed intellectual ways of, say, generating vaccines as an example, all of which are outperforming the market pretty dramatically. And so we think this rise of intangible assets in the equity markets is here to stay and will actually yield investors very well through the full cycle.
And David, how will that hunt for yield and the weakening dollar trend that we're seeing right now play out the rest of the year?
So we believe that actually we'll continue to see quite a lot of money which has been moved into money market accounts. And that's both been true on the institutional side as well as on the retail side, will come back into the fixed income markets in the second half of this year. So flows have actually been pretty good in this last quarter, and we would expect them even to be better over the next 6 months. So there will be a lot more money in motion as people come off the sidelines. And that will be particularly true as we get a better line of sight into when a virus vaccine will actually be available. I think that will be the defining moment when people say, okay, now I get off the sidelines and I move into some of these risk assets.
David, the president's electoral musings aside, how much risk are you assigning going into November?
You know, it's a really interesting question. I mean, markets, of course, for forever hate uncertainty, and they've always been particularly volatile in September and October before a presidential election. And funnily enough, we're not seeing that this year. And at least my personal hypothesis is that, actually because of the pandemic, the fiscal policy that any administration will need to follow for the next 18 months is pretty clear. There's not going to be a lot of room for the usual differences between Democrats and Republicans. And since we have pretty good line of sight of what that fiscal policy will be, I'm not sure we'll see the same level of volatility leading into this. I will say one of the interesting things is I've seen an amazing amount of market interest in the Senate races. You know, those handful of Senate races that could turn the Senate is what has people really focused on whether longer term, if we do have a Democratic administration, and if we had both houses and the Senate move, that would be a major move in policy and probably to the left.